Have you heard about the story about Ronald Reed, the janitor who died in 2014 with $8 million in the bank? Yes, you did hear correctly. Janitor. $8 million. He also didn't win the lottery or get it as a gift. He just saved money over the course of his life and let compound interest do its thing. The lesson is that how you treat money often matters more than how smart you are. Even if you didn't go to Harvard or work on Wall Street, you can still get rich by being a good person. According to Morgan Housel, financial success is not a hard science, it's a soft skill, where how you behave is more important than what you know. This is a 5-point summary of Morgan Housel's book, The Psychology of Money. Welcome to the Financial Flow. Please like and subscribe to our channel and turn on notifications to stay up on our latest videos. Point number 1. Price has to be paid. Say what you want to buy a new, nice watch. You go to the store to see what's available. You really want to do something that will impress your friends and that lovely girl you're dating. You have a choice now. Either pay for the watch or steal it and run. Since you've already done your cardio, right? I think you would pick option number 1. No matter how strong you are, you'd pull out your card and swipe it. That's the right thing to do. The point is that you know that getting a new watch will cost you, or cost you a fee. Investing has a cost too, just like everything else. For high returns, there are some lessons that keep coming up, and one of them is to have a somewhat concentrated portfolio. Peter Lynch might be an exception though. Your performance will be volatile because of how concentrated your portfolio is. This is the price, or fee, for long-term high returns on the stock market. If you don't have the stomach to stay the course when your net worth drops by 20% in a week, as if 2 of your big holdings announce quarterly earnings below expectations, don't maximize your returns. The better the returns, the higher this cost is. Stock market investing is wonderful for creating wealth. It's not free, so don't kid yourself. Volatility is the price investors pay for a brighter future. Point number 2. Just not enough. Capitalism is great at 2 things: making people rich and making people jealous. The desire to do better than your neighbors, peers, and friends can motivate you to work hard and really make it. And while it's good to be inspired to be more productive and do work that matters, social comparison can also make us feel like we're never enough. Let's look at some stats. To be in the top 1% of earners in the US, you'd need to make somewhere around $500,000 a year. That's how much a highly specialized doctor, let's call him Bill, and by almost any standard, Bill would be considered wealthy. He can afford to drive nice cars, take long trips to faraway places, and maybe hire someone to do work that he finds boring. Bill has been feeling good about himself and what he has accomplished financially in his life. Well, that was until he bought a vacation home in the Hamptons and found out that Stan was his neighbor. Stan is one of the top 1% of the 1%. He is the CEO of a very large public company and makes a shocking $10 million a year. Now, you'd think that at least Stan would be happy with his financial success, but nope. This guy was Michael Jordan's childhood friend, and this all-time great basketball player is a member of the 1% of the 1%. And well, compared to Michael's wealth of about $2 billion, Stan's annual salary of $10 million seems like nothing. Does it end here? Well, no, it doesn't. Because Michael goes to parties with famous people where Jeff Bezos sometimes shows up. Bezos is in the top 1% of the top 1% of the top 1% of the top 1%, and he made about $75 billion more in 2020, bringing his net worth to about $200 billion. There is always something bigger. This kind of comparison has led to a kind of envy that has made a lot of people do stupid things throughout history. Some people have used a lot of debt to move up the pyramid, only to lose everything and then, well, kill themselves. Some people have acted on information they got from insiders and lost both their reputation and their freedom when they went to jail. Many have left their families, and as a result, their partners have either left them or cheated on them, or both. If you learn how to be a successful investor, you will probably reach a level of financial freedom that most people can only dream about. But at some point, you have to admit that enough is enough. Point number 3. The definition of insanity is subjective. At first glance, it might look like a lot of people do crazy things with their money. Some people spend ridiculous amounts on ridiculous things, and others hide it under their mattresses. But it's important to remember that everyone has a different upbringing, parents, life experiences, and education. All of this leads to different viewpoints and values. What seems crazy to you might be totally logical to me. In the book, Morgan uses lottery tickets as an example. US households with the lowest incomes spend more than $400 a year on the lottery. This is 4 times the average in the highest income group. Combine this with the fact that more than a third of Americans can't come up with $400 in case of an emergency. Do these people use their emergency buffer to buy lottery tickets? Seems crazy, doesn't it? But again, as individuals, we don't have the same view. Try to see it from their perspective. They live paycheck to paycheck, have no room to save money, often lack education and a decent career trajectory. By buying a lottery ticket, they are joining the dream that many of us already live. So they buy more lottery tickets than we do. Possibly not so crazy after all. So how does this make you a better investor? By acknowledging that we're different, we're less inclined to mimic an investment portfolio or technique that doesn't suit our aims. Our individual risk profile may be higher than a billionaire since we focus more on becoming rich than staying rich. Copying the billionaire's portfolio may not be the best for your aims. Acknowledging disparities can also help us say no to investments outside our circle of competence. Take GameStop as an example. Since I am not a trader, I didn't take part in this drama at all. It's just not my turn to do it. Understanding different people's perspectives, or at least that there are different ways to look at the world, will help you make sense of our society and find your own way. Point number 4. Be ready for surprises. What do the Great Depression, World War II, financial crisis, and COVID-19 all have in common? All of these things changed our society, had huge effects on the financial markets, and were almost impossible to predict. Human nature makes us think we should have known it was going to happen all along. Picture it's Black Monday in 1987. How would you have felt if the market lost almost a quarter of its value in one day? Here's an interesting fact. If you invested in the S&P 500 index 20 years ago but missed the 4 best stock market days, you would have made 164% instead of 291%. That's a very big change. The lesson here is that it's better to be mentally and financially ready for a disaster you can't see coming than try to be the first person to react. Stop listening to macro projections. The things that will make investors very worried in the future are the ones that are unlikely to be predicted. Point number 5. The allure of pessimism. If I told you a bunch of reasons why the market will crash later this year, like how big the US government's debt is, how stimulus checks could lead to inflation coming back, and maybe something about new strains of COVID-19, you would probably be interested but might also end up with a pretty negative view of where we are in the market cycle right now. If I instead gave you reasons why things are probably going to keep getting better, like how life expectancy is going up, renewable energy is getting cheaper, or computing power is exploding, you would probably just shrug your shoulders and move on. We all know that a pessimist sounds very smart, while an optimist sounds naive in comparison. Why is that? We tend to listen to pessimists more carefully, not only because of how we evolved, but also because progress is much slower than setbacks. Usually, progress doesn't happen overnight, but setbacks do. Because tragedies and setbacks happen over shorter periods of time, it's much easier to make a compelling story about them, so they get more attention. To tell a hopeful story about the future, we need to look at longer time horizons. This often becomes less clear and dramatic. Knowing that you might be more interested in a pessimist than an optimist could help you be less biased in the future. Hans Rosling of Sweden would say, "The world is better than you think." So you can't get rich on the stock market without paying the price of volatility. Envy is the worst of the 7 deadly sins. Risk what you have and need for what you don't have and need. Different viewpoints make different behaviors rational. Instead of predicting crises, prepare emotionally and financially to survive them. Also, be wary of investment advice. know that pessimism appeals more to your survival instincts than optimism. Thanks for watching. Don't forget to leave a like and subscribe to our channel for more content like this. Have a good one.